one of which will unmute himself so that I can get response from you, then we start. Steven, unmute yourself. You are hearing me. One of you should just unmute himself so that I can know you are hearing
me. We can hear.
Okay. So you hit yours on mute so that I can be getting feedback from you, okay?
Okay.
What to do for an apology for not meeting earlier, but I think the network wasn't good and it's better this evening. So I'm supposed to take you through principles of accounting and management for this semester. And by way of introduction, we will be looking at some basic things in accounting. The intention of this course is to equip you with accounting background so that you'll be able to navigate the issues even though you are an IT student. If you have money and decide to be an accountant, it will benefit you. So this study human aiming to know how the information assist in decision making. Also describe the component of what a balance sheet is. That analysis relates them to changes in the balance sheet, compare features of businesses. So we say type of business we are talking about. So proprietorship, partnership, and then corporations. And then also to know background or financial statement such that when you see a financial statement, you can understand it. So businesses so that they don't record financial information until 1494, where a man known as Luca Yoli introduced a form of recording accounting information. So start from there, that accounting information are generated from business transactions or business dealings. If they were doing it by way of writing on papers and scrolls, big ledgers, and then computer was introduced into it, where those big mainframe computers were used, typewriters were used, until now that we have softwares for accounting recordings. So that is how accounting started. Now, what then is an accounting? Generally, when we talk about accounting, it's a process of identifying recording, summarizing, and reporting economic information for decision makers to use in taking decisions. When we say economic information, we are talking about value, value. Information that leads to losing money or bringing in money. So when we talk about they are people that uses financial information. And so these people we have about uh, generally we have two categories: internal users of financial information and external users. And so when you take a business, internal users are the people within the business. For instance, the employees, the owners of the business, shareholders, and others. They are the external will be government agencies and then other potential investors. Each of them has a particular need in every information that they get. For instance, one of the external users are government agencies like GRA. Their intention is to see your financial statement so that they see how much profit you are doing. Then they will know how much tax to charge you to pay. And so everybody, and then we have investors out there, they want to see the financial statement and know how good your business is doing so that they can invest in it or not. So everybody with the intention on why you want to know how your business is doing. And the only way someone can know how your business is doing is through your financial statement. And so what then do we mean when we say financial statement? The financial statement are about 4 or 5 items that are brought together to give meaningful information to users of accounting information. So the focus on specific needs of decision makers. So the nature of accounting. Accounting system is a series of steps performed to analyze, record, quantify, accumulate, summarize, and classify uh, financial information in a way of report to give meaning to economic activities that are occurred. Don't forget that accounting basically records past transactions and past issues, things that have already happened. That is the type of information accounting records. Now, when we talk about the users, like I've explained to you, you will see that in every activity, there is somebody who have an interest in a particular side. So, for instance, managers of a company want to know if a new product will be profitable. So, if they have introduced a new product, they wanted to know whether it is profitable, is profit making by comparing the revenue or the income generated against the expenses they have made in generating that income. The owners want to know which employee are productive or which method of production is profitable. Investors want to know if a company is doing good so that they can invest in it or sell their investment. And government will also want to know how they are doing so that they can know whether they are paying tax or if they should give an incentive to promote them. So all these people, users of their various stress in financial information. The bank would like to know how your business is doing in order to agree to give you a loan facility or to give you a guarantee or anything. They also have some specific thing they want to know. Yeah, information. I told you that counting of gathering, classifying, analyzing, and reporting financial issues. So that act of gathering, bring it together. If you make a sale, you write it. If you make do some credit purchase, you buy something on credit, that means you buy something without paying immediately. You record it. Somebody donates something, you record it and record the value. If you transfer something to some place, you record all those things. Anything that has economic value, we call them transaction, business transaction. And business transactions could be classified into two: financial transactions and then non-financial transactions. Financial transactions are all those activities or events that has to do with money. So the fundamental relationship in decision-making process is that you gather all this information. The information will be gathered by financial people like accountants or financial analysts. They record them, classify them to prepare financial statements. Now, when we talk about financial statement, there are a group of statements that bring together to make meaning for a business financial operation. So financial statement is made up of income statement or statement of profit and loss, or you can also call it statement of financial performance. And then it's also that statement of financial performance tell you whether a company is making profit or loss. After that, we also have statement of financial position, which is basically called balance sheet. This statement records the effect of a business, or it shows the resources that the business is having. It also shows the amount of money that have been invested into that business. And if the business is owing somebody, statement of financial position shows that information. Alongside that, we have what we call statement of cash flow or cash flow statement. This statement shows the inflow and outflow of money in a business. In other words, how money comes in and how money is spent out. After that statement, we also have that small statement explaining these four statements. And we call that notes to the account. Notes to the account. So these five things brought together to form what we call financial statements. And this is given to users, people who need it, of which they will pick information for decision making. Now, care and management accounting, we want to look at the basic, what those terminologies means. Financial accounting, what does it mean? Management accounting, what does it mean? The major distinction between financial and management accounting is the users of the information. And so, for instance, financial accounting can be used by both internal and external users. But for management accounting, it's used basically by internal users. Internal users. So financial accounting is prepared by financial accountants, and then the management accounting is also prepared by a management accountant. That's that both of them will have different interests. One is meant for internal consumption, the other one is for external consumption. The primary question about an organization's success that decision makers want to know are what is the financial picture of the organization on a given date or time? How well did the organization do during a given period? Usually 1 year. We call it financial year, or accounting period. So final account or financial statement is prepared after the financial year or the accounting period. And that is what everybody is interested in, to know what is going on in the business. It's an annual report and it's regulated. It's regulated. So like I said earlier on, the components of the financial statement are what you see. It's also known as statement of financial position. The income statement, which is also known as statement of profit and loss, or statement of financial performance. Then the cash flow statement, and then you have notes to the accounts. Now, the reason why business keep account for those users can therefore be summarized as follows. 1, to comply with legal and other requirements. So it is a requirement by government that at the end of every year, business meet their account. 2, the various agencies. Number 1, the Registrar General. Number 2, to the tax authorities. And then number 3, to the owners of the organization. So also to provide information for shareholders. When we say shareholders, we are talking about owners of the organization, those who invested into the organization, about their financial performance and the viability of the business. Also to provide managers with information for decision making. So for instance, if you deal in one product this year and it is not meaningful, you may want to add a new product. If you add a new product and you realize that the new product is rather costing the business more than the old one, then you would want to change your model and bring in another product. Of course, there are these products that you will not make profit, but it brings people in to buy other products. So through the accounting information, you can deduce whether to maintain a line of production or to close it down. It's also to provide a structure to business activity based on the careful processing of numerical data. So for instance, it will help you to know whether to produce something and sell or to buy it and sell. You people, you are IT people. So when you look at your account, you will know whether to buy a software and install for a client or to develop it yourself. When you develop it, the accountant will cost it how much you spend in developing the software. And then when you buy the software to install for the client, you also check how much you spend in buying it. So you weigh the two. If it is profitable to buy and install than to develop it, then you will choose the best. So financial information will help you to do those things. The quality of useful financial information. Now, financial information must be timely. It must be timely. It should be prepared on time so that it could be used within the time it is needed. It should be relevant. It should be relevant to the business of the organization. And it should be understandable. When people look at it, they should understand it. They should be able to see that, oh, you said this is your total income you have received. This is your total expenditure you have made. It should not be complex. It should be reliable. You don't lie in it. You don't just quote figures in the accounts, but it should be reliable and it should be comparable. You should follow the same format so that you can compare this year to next year. You can compare last month to the previous month. It should be like that. If the financial statement or the information is not like that, then it's not a good financial information. The notes explain the qualities as I just explained to you, but I will emphasize on the reliability. You see, a person invests into a business. His expectation is that he will make profit out of it. Usually, the person who invested into the business is not in the business working day to day. He engaged managers who are managing his money for him. So at the end of the year, he will prepare an account for the managers, the owners to see. The information should be reliable. He should not just put figures to impress the owners, but the figures should be something that can be relied on. So for those figures, that is why auditors come in to check what you are reporting that you have made, whether they are correct or they are not correct. What you are supposed to do, whether you have done it or you didn't do it. What you say you have bought, whether you bought it or you just write there that you bought it. And if you buy, how much have you bought it? And how much is it sold in the market? What receipt have you received to show that the thing belongs to you? So auditors come in to check those things to make the information reliable for anybody to rely on. Now, we look at the type of business. The type of business ownership determines the nature of the accounts to prepare. And so basically, we have three types of business ownership. The sole proprietorship is one-man business. It's very common in Ghana, where a person can get up and say, I want to start a business, and he alone bring in money and start the business. Each of them have advantages and disadvantages. For the sole proprietorship, the person who brings in the money is the only person who will take any profit that comes, any loss that comes. But when we look at partnership is a group of 2 or up to 50 people coming together to put resources together to form a business. They share the profit when it is made, and they also share losses when it is made. If we go into the detail of partnership, you will realize that the partners may decide to contribute in a certain proportion to the business ownership. And the same way, when there is profit, they share it according to the proportion of their capital contributed. And as well as when there's a loss, they share it based on the capital contributed. And so if somebody has contributed more, it's expected that when the company make more profit, you will get more. The opposite is if the company make a loss, you will get more of the loss. And also we have a corporation. A corporation are big entities. They are open to the public to join and take part ownership of them. They are more than 50 and above. There are companies that are listed, some on the stock exchange market, where anybody at all can go and buy a part of it that we call shares. Shares. So shares are portion of ownership in the company. Good. So these three types of company ownership have their advantages and disadvantages, like I mentioned earlier. You can read from the slide and it will help you. It's so clear in the slide. Now, let's look at some features. In sole proprietorship, the owner of the company runs the company himself. He is in there for the day-to-day operation of the company. Now, when we come to partnership, they that the activity of the business. Sometimes there are various, some may be dormant partners. They only contribute, and some are part of the running of the business. And so profit is shared based on these agreements. And when we talk about the corporation, shareholders, they don't do anything at all in the business. They are not in the business. They only come and bring their money with the company to use. The company engage managers for the running of the day-to-day activity. At the end of the day or the year, they report to the owners. That is why we have the AGM, annual general meetings, for them to report to the owners of the company. Like I said, the advantages and the disadvantages of the three kinds of business ownership is in these slides for you to look at. The financial statement. Let's look at financial statement. So the convention of financial accounting are particularly significant to the development of accounting theories in two ways. One, they are themselves part of an empirical process for developing rules of financial accounting. They may be regarded as belonging to a body of accounting theory. What does this statement mean? What we are saying is that George, we are getting feedback from you. The financial statement is guided by rules and regulations that we call standards.
It comes to I don't go live for you. Why? Two for do morning time. Why?
Can you mute yourself, please?
Today. Yes.
George, we are getting feedback from you. And so the financial statement preparation are guided by regulations that are developed by standard boards. In Ghana, for instance, ICAG, Institute of Chartered Accountants, is an institution that has been established by an Act of Parliament to regulate the preparation of financial statements so that they can reflect or they can be uniform and meet a specific standards. And institution, kinds of institution have a pattern of reporting. For instance, public sector institutions are guided by the Public Sector Financial Management Act and regulations. And the private sector too is guided by a general accounting standards and then financial reporting standards. So let's look at what an accounting concept are. So accounting concepts are principles that guides accounting, the concepts, the principles, the values, the rules that guides the preparation of financial statements. So one of those principles or concept is the historical cost concept. Historical concept states that transactions or things that are recorded in financial statement, they are things that have actually happened. It has already happened. It's not forecasted. It has actually happened, and it is at the cost at which it has happened. So if you buy a phone like 2,000 cedis today, and tomorrow they are selling it 2,500, you are recording 2,000 cedis, not 2,500. That is what we mean when we say historical cost. Again, when we also talk about money, the money measurement concept, we are talking about how you can value something in a monetary terms. Can the thing be measured in monetary terms? Okay, somebody has given you a chair. Can the chair be measured that this chair costs 200 or 500? Can you measure the thing? If the thing is not measurable, then you can't account for it. So for instance, let's say if somebody say, I love you, can you give monetary value to that word? No. So you can't account for love in finance. But if somebody do a gift, let's say the person bought a hamper for you, you can quantify the value of the hamper. And so you can account for that item that the person has given you. I hope you are getting the difference. Yes. Now, when we talk about business entity concept, this concept only means that every business is separated from the owner. The business is also a legal person that can be sued and can also sue. So, for instance, if you have a business, the business is not you, and you are not the business. Once the business is registered, the business is seen by the law as a person. People, even though it is your business, you are separate individuals. Somebody can take your business to court and not you yourself that has been taken to court. Now, the concept of dual aspect concept, it states that there are two aspects of accounting. One represented by the assets of a business and the other one by the claims against the business. This concept states that these two aspects are always equal to each other. In other words, this is what we refer to as the accounting equation. What means is every is the same as say assets. We are only talking about double for producing or for generating. That should be equal to the things that you put into the business. So, for instance, when we say capital, we are talking about the amount of money you put into the business. And when we talk about liability, we are talking about the things that you credited into the business. So, take note of this equation. The whole accounting revolves around this equation. So, take care of it. This is just an introduction. So, we will later go into it by way of calculation for you to see. Now, we also talk about the time interval concept. One of the underlying principles of accounting is that final accounts are prepared as regular intervals of 1 year. For intervals management purposes, they prepare far more frequently, possibly on monthly basis or even more frequently. What this means is that accounting information are prepared periodically. So you can decide to prepare information every week, every day, every month, every 3 months, every half year, and every year. And each of them should be consistent. And so that you will be able to compare what happened this week to next week, or what happened this month to next month, or what happened this year to the next year. That is how you prepare your thing. So when you follow these concepts, you are sure that every information that you have presented, somebody who comes to chance in it or who needs it for decision making can make meaning out of this. Ladies and gentlemen, today this is how far we'll end our lecture. If there's any question, you can ask. You just need to unmute yourself, and then you ask the question. Hello? Francis, can you hear me? Francis, can you hear me? Can you unmute yourself? Mr. Saki,
Yes, sir.
if there's any question.
No, please. No question at my end.
Okay, so you have a question?
So, sorry, sir, that I don't have any question. There's so much noise, so I have to.
Good.
No, please.
Okay. It's just there. Okay, Prince, do you have any question for us?
No, sir.
Okay. So today we introduce ourselves because it was late. The morning where I was, the network wasn't good. So forgive me. The next lecture we'll find time and introduce ourselves. If you have any question or anything, you compile them so that when we meet next time, we'll look at it. Thank you very much. I wish you the best of the weekend. May the Lord continue to be with you all.
Amen.
Amen.
Amen.